Welcome to our new IFRS Educational Fund Series. It's an initiative of OG Inspiration Limited. It is dedicated to providing complementary and supplementary education on International Financial Reporting Standards IFRS through a multiple choice question and answer approach. It is intended to make learning and intellectual assurance fun. In this session, which I will consider 10 questions of set 1, to which the answers have been provided on IAS 33. This is standard on earnings per share. Viewers and subscribers have 30 seconds to select or choose their answer to each question. The answers to the 10 questions are reviewed at the end of all the questions. Please enjoy it. Question number 1. For which of the following entities is reporting of earnings per share mandatory? A, all reporting entities under IFRS apart from non-profits. B, all private companies. C, all publicly quoted companies. D, all profit-making companies. E, all entities with shareholders. Time counts. Ten seconds gone. $20 seconds gone. Time up. Question number 2. Where an entity presents its consolidated financial statements together with its separate financial statements, on which basis must the earnings per share be computed and reported? A, individual financial statements. B, separate financial statements. C, separate and consolidated financial statements. D, consolidated financial statements. E, individual and consolidated financial statements. Time counts. $10 seconds gone. $20 seconds gone. Time up. Question number 3. Where statement of profit or loss is presented separately, the earnings per share information is presented in dash. A, statement of profit or loss. B, statement of other comprehensive income. C, statement of comprehensive income. D, statement of changes in equity. E, none of the components of financial statements. Time counts. $10 seconds gone. $20 seconds gone. Time up. Question number 4. The increase in loss per share resulting from the assumption that options are exercised upon the satisfaction of specified conditions is called dash. A, options. B, anti-dilution. C, dilution. D, put options. E, potential ordinary shares. Time counts. $10 seconds gone. $20 seconds gone. Time up. Question number 5. One of the following are not potential ordinary shares. A, convertible debentures. B, convertible preference shares. C, options. D, warrants. E, treasury shares. Time counts. $10 seconds gone. $20 seconds gone. Time up. Question number 6. The calculation of basic earnings per share is with respect to dash. A. Ordinary equity holders and preference shareholders. B. Preference shareholders only. C. Founders share only. D. Ordinary equity holders only. E. Founders shares and preference shareholders. Time counts. Ten seconds gone. 20 seconds gone. 'Time up. Question number 7. Preference share that provides for a low initial dividend to compensate an entity for selling the preference share at a discount can be called dash. A. Decreasing rate preference shares. B. Increasing rate preference shares. C. Investors rate preference shares. D. Founders rate preference shares. E. Convertible preference shares. Time counts. 10 seconds gone. 20 seconds gone. 'Time up. Question number 8. In calculating basic earnings per share, the number of ordinary shares outstanding during the period used as the denominator is determined as dash. A. Nominal number of ordinary shares. B. Simple average number of ordinary shares. C. Weighted average number of ordinary shares. D. Expected average number of ordinary shares. E. Projected average number of ordinary shares. Time counts. 10 seconds gone. 20 seconds gone. 'Time up. Question number 9. For a convertible debenture, which of the following holds with respect to diluted earnings per share computation? A. The potential ordinary shares are deducted from existing ordinary shares. B. The ordinary shares are divided by the potential ordinary shares. C. Interest expense on the debenture is deducted in arriving at the relevant profit. D. Interest expense of the debenture is added in arriving at the relevant profit. E. The weighted average number of ordinary shares are the non-dilutive ones only. Time counts. 10 seconds gone. 20 seconds gone. 'Time up. Question number 10. If the number of potential ordinary shares outstanding in a current period decreases as a result of reverse split, the calculation of diluted earnings per share for the comparative period A leads to reduction in earnings per share. B leads to increase in earnings per share. C leads to no difference in earnings per share. D is determined as the average of that of the previous figure of the comparative period and that of the current period. E is determined as the difference between the previous figure of the comparative period and that of the current period. Time counts. 10 seconds gone. 20 seconds gone. 'Time up. We proceed to reveal the answers. Question number 1. The answer to question number 1 is C, all publicly quoted companies. Whether an individual, separate or consolidated financial statements, IAS 33 is only mandatory for 1, an entity whose ordinary shares or potential ordinary shares are traded in a public market, that is a domestic or foreign stock exchange or an over-the-counter market, including local and regional markets. Or 2, an entity that files or is in the process of filing its financial statements with the Securities Commission or other regulatory organization for the purpose of issuing ordinary shares in a public market. C is the answer to question number 1. Question number 2. The answer to question number 2 is D, consolidated financial statements only. IAS 33 provides that when an entity presents both consolidated financial statements and separate financial statements, the disclosure required with respect to earnings per share need be presented only on the basis of the consolidated financial statements. Although not mandatory, an entity that chooses to disclose earnings per share based on the separate financial statements does not present such information in the consolidated financial statements. D is the answer to question number 2. Question number 3. The answer to question number 3 is A, statement of profit or loss. Where an entity presents statement of profit or loss separately, it presents earnings per share information only in the statement of profit or loss. A is the answer to question number 3. Question number 4. The answer to question number 4 is C, dilution. IAS 33 defines dilution as a reduction in earnings per share or an increase in loss per share resulting from the assumption that convertible instruments are converted, that options and warrants are exercised, or that ordinary shares are issued upon the satisfaction of specified conditions. C is the answer to question number 4. Question number 5. The answer to question number 5 is E, treasury shares. Potential ordinary shares are financial instruments or other contracts that may entitle their holders to ordinary shares. They crystallize when certain conditions are met. Treasury shares, which are an entity's own equity instruments, are not potential ordinary shares in themselves. E is the answer to question number 5. Question number 6. The answer to question number 6 is D, ordinary equity holders only. Basic earnings per share is calculated for ordinary equity holders only. As a result of this, the after-tax amounts of preference dividends, differences arising on the settlement of preference shares, and other similar effects of preference shares classified as equity are adjusted out. D is the answer to question number 6. Question number 7. The answer to question number 7 is B, increasing rate preference shares. Preference shares that provide for a low initial dividend to compensate an entity for selling the preference shares at a discount can be referred to as increasing rate preference shares. B is the answer to question number 7. Question number 8. The answer to question number 8 is C, weighted average number of ordinary shares. In line with IAS 33, for the purpose of calculating basic earnings per share, the number of ordinary shares is the weighted average number of ordinary shares outstanding during the period. C is the answer to question number 8. Question number 9. The answer to question number 9 is D, interest expense on the debenture is added in arriving at the relevant profit. For the purpose of calculating earnings per share, an entity adjusts profit or loss attributable to ordinary equity holders by adding any interest expense and dividends related to dilutive ordinary shares for the period. The entity also adds expenses and deducts income that will result from the conversion of dilutive potential ordinary shares. D is the answer to question number 9. Question number 10. The answer to question number 10 is B, leads to increase in earnings per share. IAS 33 provides that if the number of ordinary or potential ordinary shares outstanding increases as a result of a capitalization, bonus issue, or share split, or decreases as a result of reverse share split, The calculation of basic and diluted earning per share for all periods presented are adjusted retrospectively. This affects the denominator only in the formula. Since the question is that of a reverse share split, it leads to the reduction of the weighted average number of shares. With a reduced denominator and with a numerator remaining unchanged, the diluted earning per share for the comparative period will increase. B is the answer to question number 10. Thank you all for joining us for this set one of IAS 33 earnings per share. We invite you to subscribe to our channel, share our links, and invite those in your network to do the same. This will enable you and all other subscribers to get direct notifications on future video uploads. We intend to cover all of the standards in this framework and create further sets of questions and answers on standards already covered. For collaboration in this area, please call our WhatsApp +2349 030 770109. All rights to this production and others in the series are reserved for OJ Inspiration Limited. Thank you once again, and bye for now.